In this video, we are breaking down a fresh interview with 𝗗𝗏𝗧, Head of Research and Chief Investment Officer at Fundstrat Capital, where he delivers a strong warning about AI, jobs, and what it means for markets. 𝗗𝗏𝗧 recently appeared on Squawk Box Asia and explained why a stronger-than-expected U.S. jobs report may not tell the full story. According to Tom, AI is already disrupting software and tech, and job losses could follow as a result. He also shared his view that the Federal Reserve under Trump nominee 𝗗𝗏𝗏𝗧 could end up being more dovish than markets initially expected. I am going to play the clip of 𝗗𝗏𝗧 from CNBC, and right after that, I will give you my own reaction and breakdown of what he said. Then we will dive into an in-depth analysis of 3 oversold software stocks to buy right now. Make sure to hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Let's hear what 𝗗𝗏𝗧 has to say.
That you are spending some time very early this morning with our U.S. colleagues talking about this U.S. jobs data. Do you think it perhaps changes your thinking in any way, or the revisions matter more?
I mean, a little bit of both. You know, I think the Fed Chair Powell says he subtracts $65,000 a month from any jobs report because he knows the revisions are negative. Yeah. But I think that it's not lost on the Fed that AI is sort of wreaking havoc across software now. And that means the jobs losses are soon to follow. So I think the stock market isn't going to care about the labor reports in their minds, because in the back of their minds they're going to say, well, how much of these are going to be lost in the future due to AI?
Mm-hmm. Do you think 𝗗𝗏𝗏𝗧 and his Fed would care more about what AI is doing to the jobs picture and how inflation is sort of behaving at the moment? What are your expectations? Because at the start, I mean, right upon the announcement of his nomination, market was acting like he's a hawk.
Correct.
You don't agree with that market reaction?
Yeah, I mean, I think the market reaction, and I think they're rethinking it, didn't make sense because Trump wouldn't appoint a hawk. But it looks like Fed, you know, the new Fed, Warsh, actually does want low rates but a smaller balance sheet. But to me, in 2026, the overarching story is that if jobs are shrinking and AI is wreaking havoc across sectors. Remember, software used to eat the world, right? It's a $450 billion sector. Now that's getting eaten by AI. If software shrinks, that's deflation. So I think the inflation picture, and AI is showing it's actually disinflationary. And we get a CPI report in January from this Friday, but core CPI year over year might drop to 2.52. That's the average from 2017 to 2019. We're back to pre-COVID inflation. So I think we have a dovish Fed coming, and then Fed funds rates were like 1.5, 2.0 back then. So I think there's a lot of room to cut rates. So I think it's a disinflationary environment.
And when the Fed stays dovish for those reasons that you're just laying out and even go for a couple of cuts later this year, does the market react to that positively? Because it matters why. If AI is eating jobs and AI is affecting software in a negative way, is that a good thing for the markets?
Yeah, it is. But it's creating winners and losers. That's what the stock market's trying to figure out. Last year, they were buying the Mag 7. Those are like the armies. This year, people are buying energy, industrials, commodities, you know, power generation, chips. Those are the bullet makers. So they're still buying AI, but they're buying the guys that receive the CapEx. I think software may be a net loser, but that they're a distributional consequence of AI.
When I know that your outlook for this year is that we're going to do okay in the first half, and then there could be some bear market like a drawdown and then pick back up. So number one, are you sticking to that outlook?
Yes.
And number two, when that does happen on the U.S. market, how does that affect international markets? I feel like you're spending more time paying attention to what's going on international markets. Does that have a sort of simple spillover effect to the rest of the world and to Asia, or does international outperform the U.S. again in 2026?
I think there's a scenario where the drawdown, we think it's a three-phase market. So let's say we get into the period where the U.S. stock market declines 10, 15, or 20%. A lot of that is probably a rotation out of Mag 7. So out of the armies and plowing into industrials, financials, everything else. But Mag 7 is 55% of the market, right? That's a big complex. That's probably bullish for non-U.S. because non-U.S. country indices are industrials, materials, everything but tech. So I think it actually is bullish for non-U.S.
Yeah, and speaking of gold, Tom, a lot of crypto bros, sisters, people, I mean, even at Consensus, it felt quiet. Maybe it's really the crypto headlines that I've been reading about. And in the event yesterday, it just felt more contained and quiet. Perhaps it's really the FOMO over gold and really disappointing price action in crypto space. So my first question, your end of January calls for Bitcoin and Ethereum, they were pretty bullish, but it didn't really materialize.
Yeah.
What were you looking at? What were some of the factors that you thought would drive up Bitcoin and Ethereum by the end of January? Why January?
Crypto had a price shock in October. And that was, in terms of deleveraging, bigger than November 2022 when FTX failed. That was, in 2022, the bottom for crypto. Crypto was beginning to recover from that carnage because it takes about 6 to 8 weeks. And historically, crypto recoveries are V-shaped. But I think a couple things happened that really hurt us in January. Number one was, in October 10th, we had a tweet about China that over the weekend caused huge ripple effects. Well, we had a Greenland tweet that triggered another cascade of liquidations. So crypto basically got chopped at the knees again. The second is that crypto investors have been frustrated, as you correctly point out. Consensus in Hong Kong, the mood is horrible because past crypto winters, which are bear markets, happen when the stock market's declining. So people don't feel bad about like, oh, I'm stuck in crypto, but like everything stinks. But actually stocks have been okay and gold has been really good. So now people have like this egg on their face saying, am I a dunce for staying in crypto when I could have just been buying gold? Well, that is playing into the psychology because gold started to do really well in January. So I think FOMO plus the fact that there's now double negative leverage effects because of Greenland means crypto is, it looks really like it's bottoming because the fundamental story of crypto is quite positive.
The interview opens with a discussion around U.S. jobs data, and right away Tom sets the tone. He basically says that headline job numbers do not carry the same weight they used to. He points out that even the Fed internally discounts monthly job reports because revisions are often negative. That alone is interesting, but the real point he makes is much bigger. In his view, the labor market data is almost backward-looking now, because AI is already disrupting software and white-collar jobs in ways that have not fully shown up in employment reports yet. Personally, I think this is one of the most important points in the entire interview. Markets are forward-looking, and if investors believe that AI-driven efficiency is going to eliminate roles across software, tech, and services, then today's jobs numbers become less relevant. It is not that jobs do not matter anymore, but that the market is already thinking about how many of those jobs will not exist a year or two from now. That changes how traders interpret every labor report. The conversation then moves into expectations around the Federal Reserve and leadership changes. Tom talks about Kevin Warsh and whether a Fed under his influence would be more hawkish. The market initially reacted as if Warsh would be aggressive on rates, but Tom disagrees with that narrative. His argument is simple. If political leadership wanted higher rates and tighter conditions, they would not choose someone known for wanting lower rates alongside a smaller balance sheet. What really matters here is Tom's broader outlook for 2026. He argues that if AI continues to shrink employment and disrupt entire sectors like software, that is inherently deflationary. Software was once described as eating the world, and now AI is eating software itself. When a $450 billion sector starts shrinking, prices come down. That pushes inflation lower, not higher. I tend to agree with him here. There is still a lot of fear around AI being inflationary because of energy use and infrastructure spending, but the productivity gains are massive. When companies can do more with fewer workers, wage pressure eases. That does not mean job losses are good for society, but from a pure macro and market standpoint, it supports a disinflationary backdrop. Tom reinforces this by pointing to upcoming CPI data. He suggests that core CPI could fall back to levels we last saw between 2017 and 2019. In other words, pre-pandemic inflation. If that happens, the Fed suddenly has a lot of room to cut rates. He even reminds viewers that Fed funds rates were much lower during that period, which supports his view that monetary policy will turn decisively dovish. Now, the interviewer asks an important follow-up. If the Fed cuts rates because AI is destroying jobs, is that actually bullish for markets? Tom's answer is nuanced. He says yes, but only if you understand that markets will produce winners and losers. This is not a rising tide lifting all boats. It is a rotation. Last year, investors crowded into the so-called Mag 7, which Tom describes as the armies of the AI revolution. This year, he says money is flowing toward the bullet makers, energy, industrials, commodities, power infrastructure, and chip manufacturers that enable AI spending. Software, ironically, may end up as a net loser because AI commoditizes what software used to do. I think this framing is extremely useful. Too many people think investing in AI means buying software companies. Tom is basically saying the opposite. The real beneficiaries are the companies receiving capital expenditures, not the ones being disrupted by automation. I personally think this explains a lot of the strange sector performance we have seen recently. Later in the interview, Tom revisits his outlook for the year. He sticks with his three-phase market view: strength in the first half, followed by a meaningful drawdown, then recovery. He defines that drawdown as potentially 10 to 20% in U.S. equities, largely driven by rotation out of mega-cap tech rather than a full-blown economic collapse. This is where international markets come into the picture. Tom argues that a rotation away from Mag 7 is actually bullish for non-U.S. markets. U.S. indices are heavily weighted toward tech, while international indices lean toward industrials, materials, and financials. If capital flows out of big tech, it does not disappear. It rotates globally. I find this argument pretty compelling. For years, U.S. equities have dominated because tech dominated. If that leadership narrows or even weakens temporarily, international markets finally get their moment. This is one of those setups where diversification actually starts to matter again. The final section of the interview shifts toward crypto and gold, and this part feels more emotional than technical. Tom acknowledges that his bullish calls for Bitcoin and Ethereum into late January did not play out. He explains that crypto experienced a major deleveraging event in October, similar in magnitude to what happened after the FTX collapse in 2022. Historically, crypto recovers in a V-shape after these events, but January threw a wrench into that pattern. Unexpected geopolitical headlines triggered additional liquidations, essentially knocking crypto down again just as it was trying to recover. On top of that, investor psychology turned negative because stocks held up and gold performed well. Instead of feeling like everything was down together, crypto investors felt isolated. This is where I actually think Tom's read on psychology is spot on. Markets are not just driven by fundamentals, they are driven by regret. When people feel like they chose the wrong asset, sentiment collapses fast. Gold rallying while crypto stagnates creates that exact feeling. Despite that, Tom remains constructive on crypto. He believes the fundamental story is still intact and that the market looks like it is bottoming. I would add my own caution here. Crypto can absolutely recover, but timing these sentiment shifts is brutal. Even if the long-term thesis is strong, the short-term can stay uncomfortable longer than most people expect. Overall, this interview ties together a single narrative. AI is deflationary, job disruption is coming, the Fed will eventually turn dovish, and markets will reward infrastructure and real economy enablers rather than just software and hype. Whether you agree with all of Tom's conclusions or not, the framework he lays out forces you to think beyond headlines and ask who actually benefits from the next phase of this cycle. And for me, that is the real value of this conversation. It is not about predicting next month's CPI print or the next crypto bounce. It is about understanding how structural shifts change the rules of the game and positioning yourself before the rest of the market catches on. Now let's dive into the 3 oversold software stocks to buy now. These are stocks that the market has punished far more than their long-term fundamentals justify, creating rare opportunities for investors willing to think beyond short-term fear. The first stock we need to talk about is DocuSign, ticker symbol DOCU, and this is one of the most misunderstood software businesses in the market right now. DocuSign is often dismissed as a pandemic winner that lost relevance once the world reopened. That narrative sounds simple, but it completely misses what DocuSign actually is and why it still matters. DocuSign is not just about electronic signatures. It is about digitizing agreement workflows across the global economy. Contracts are foundational to how business operates. Every company signs agreements with customers, vendors, employees, and partners. Historically, this process has been slow, manual, error-prone, and expensive. DocuSign sits at the center of that process. It allows businesses to create, send, sign, manage, and store agreements digitally in a secure and legally compliant way. Once a company builds its contract workflows around DocuSign, switching away is not trivial. Legal teams, compliance departments, and sales organizations all rely on these systems being reliable and standardized. That creates strong switching costs that are often underestimated. The company has also been expanding beyond simple e-signatures into what it calls Agreement Cloud. This includes contract lifecycle management, automated workflows, analytics, and integrations with other enterprise systems. The goal is to own the entire lifecycle of agreements, not just the moment of signature. That expands DocuSign's addressable market significantly and increases its relevance even as growth moderates. From a financial standpoint, DocuSign remains a highly cash-generative business. Revenue growth has slowed from pandemic-era highs, but it is still growing at a respectable rate for a company of its size. More importantly, DocuSign has focused heavily on improving profitability. Operating margins have expanded meaningfully as management cut costs, streamlined operations, and focused on disciplined execution. Free cash flow margins are strong, and the company generates hundreds of millions of dollars in annual free cash flow. That matters because it gives DocuSign flexibility. It can reinvest in product development, pursue acquisitions, or return capital to shareholders. This is not a company burning cash to chase growth. It is a mature software platform optimizing for sustainable returns. The stock, however, trades as if the business is permanently impaired. Shares are still well below their prior highs, and valuation multiples have compressed dramatically. The market is pricing in minimal growth and limited long-term relevance. In my view, that is overly pessimistic. Contracts are not going away. If anything, businesses are becoming more digital, more remote, and more complex, which increases the need for tools like DocuSign. AI is often cited as a threat, but I actually see it as an opportunity. AI can enhance contract analysis, automate compliance checks, and surface insights from large volumes of agreements. DocuSign is already integrating AI into its platform, which could make it even more valuable over time. The idea that AI replaces DocuSign misunderstands how enterprise software evolves. It usually enhances platforms rather than eliminating them. At current levels, DocuSign represents a classic quality business trading at a discount because growth expectations have reset. For long-term investors who value cash flow, moats, and recurring revenue, this setup is compelling. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The second stock on this list is Intuit, ticker symbol INTU, and this is a name that rarely shows up in oversold conversations, which makes its current setup even more interesting. Intuit is one of the most important financial software companies in the world. It operates at the intersection of small businesses, consumers, taxes, accounting, and personal finance. Its products are deeply embedded into the financial lives of millions of users. QuickBooks dominates small business accounting. TurboTax is synonymous with tax filing in the United States. Credit Karma connects consumers to credit products and financial insights. What makes Intuit so powerful is not just brand recognition, it is the ecosystem. Small businesses that use QuickBooks for accounting often rely on Intuit for payroll, payments, invoicing, and tax preparation. Consumers who use TurboTax often engage with Credit Karma. Each product reinforces the others, increasing lifetime value and reducing churn. This ecosystem creates a durable moat built on switching costs and data advantages. Once a small business runs its finances through QuickBooks, switching to another platform is disruptive and risky. Financial data is sensitive, and reliability matters more than saving a few dollars per month. That gives Intuit pricing power and resilience even in slower economic environments. From a growth perspective, Intuit continues to benefit from long-term trends. Small businesses are increasingly digital. Compliance requirements are becoming more complex. Consumers want easier ways to manage their financial lives. Intuit is positioned to capture all of that. The company has also been aggressively integrating AI into its products to automate tasks, provide real-time insights, and improve user experience. Financially, Intuit is a best-in-class operator. Revenue growth remains solid, operating margins are strong, and free cash flow generation is excellent. The balance sheet is healthy, and management has a long track record of disciplined capital allocation. This is a company that knows how to compound shareholder value over time. So why is Intuit considered oversold? It comes down to valuation compression and market rotation. As interest rates rose and investors rotated away from high-quality growth stocks, even elite companies like Intuit saw their multiples contract. The stock pulled back despite continued execution and strong fundamentals. In my view, this kind of pullback in a compounder like Intuit should be viewed as an opportunity, not a warning sign. This is not a cyclical business with fragile demand. Taxes do not disappear in a recession. Small businesses still need accounting. In many ways, Intuit's products become even more essential during uncertain times. Long-term, Intuit's ability to cross-sell, expand internationally, and layer AI-driven services on top of its core platforms gives it multiple avenues for growth. You are paying a premium relative to weaker software names, but you are also buying durability, consistency, and compounding. For investors who want exposure to software without excessive risk, Intuit stands out. The third and final stock we are going to cover is Atlassian, ticker symbol TEAM, and this is a business that plays a critical role in how modern teams work. Atlassian builds collaboration and productivity tools used by software developers, IT teams, and increasingly non-technical teams. Products like Jira and Confluence are deeply embedded into how organizations plan projects, track work, and share knowledge. These are not nice-to-have tools. For many teams, they are mission-critical infrastructure. What makes Atlassian unique is its bottom-up adoption model. Teams often start using Atlassian products organically, without top-down sales pressure. Over time, usage spreads across departments and eventually becomes standardized at the enterprise level. This creates a powerful growth engine driven by actual user value rather than aggressive sales tactics. The company also benefits from high switching costs. Once workflows are built inside Jira or Confluence, migrating away is painful. Data, integrations, and team habits are deeply ingrained. That creates long-term customer retention and predictable revenue streams. Atlassian has been transitioning its business toward cloud-based subscriptions, which initially pressured margins but strengthens the business long-term. Cloud adoption increases flexibility, improves product innovation, and creates more consistent recurring revenue. As this transition matures, profitability should improve. The market has punished Atlassian heavily due to concerns about slowing growth, valuation, and competition. Shares are well off their highs, and sentiment has turned cautious. However, the core business remains strong. Customer demand persists, usage continues to grow, and Atlassian remains a central platform for modern work. Financially, Atlassian is still investing heavily in growth, which weighs on near-term margins. But free cash flow generation is improving, and the company has a solid balance sheet. Management has been clear about balancing growth and efficiency, which should gradually restore investor confidence. AI is another area where Atlassian could benefit rather than suffer. AI can enhance project management, automate documentation, and provide predictive insights into workflows. Atlassian is already integrating AI capabilities into its products, which could increase their value and stickiness over time. At current prices, Atlassian offers exposure to long-term trends in collaboration, remote work, and software development at a valuation that reflects a lot of pessimism. For investors with a multi-year horizon, this risk-reward looks attractive. When you step back and look at all three of these companies together, a clear pattern emerges. These are not speculative plays. They are foundational software platforms that enable how businesses operate. The market is currently focused on short-term headwinds, AI disruption fears, and valuation resets. But the underlying businesses continue to generate cash, retain customers, and adapt. DocuSign dominates digital agreements. Intuit owns financial workflows for small businesses and consumers. Atlassian powers collaboration for teams around the world. Each has a moat, each has growth drivers, and each is trading at a valuation that reflects skepticism rather than strength. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these businesses do you think has the strongest long-term competitive advantage? And which one do you believe is best positioned to compound shareholder value over the next decade? Leave your thoughts in the comments and let's discuss. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.